Now, post-election, there's been a strong surge in the dollar index, and that generally impairs global liquidity because the dollar is the unit of account for the majority of cross-country debt, and anything that hardens your liability denominator compared to your cash flows is generally a liquidity draining thing. And so it's been a little bit more torn in these past few months. But that does mean that they have an arsenal to potentially drain, the dollar value, make deals, kind of like back in the 1980s, you had the Plaza Accord. We could see a Mar-a-Lago Accord or any sort of other kind of like negotiation to ease the dollar a bit. It could occur when the Fed goes back to quantitative easing, which they might do later this year, just to maintain kind of liquidity in the banking system.
Yes, it's happening again. Bitcoin, the world's most infamous digital asset, is flashing signals that have never been wrong. If history is any guide, we're on the brink of an earth-shaking rally that could leave skeptics in the dust. Sounds crazy? LYN ALDEN, one of the most respected macro analysts, just dropped a bombshell. Bitcoin's price pattern is eerily repeating itself, and if this plays out like before, we could be looking at a parabolic surge that rewrites financial history. Meanwhile, the global economy is hanging by a thread, with the US dollar at the center of it all. After the recent US election, the dollar has surged to extreme levels, putting immense pressure on countries drowning in dollar-denominated debt. This is a classic setup. A strong dollar crushes global liquidity, but history tells us it also sets the stage for explosive Bitcoin move.
Stop. You don't have time. Don't miss out this 2025 bull run. Educate yourself first ahead of the crowd. We have created the ultimate step-by-step crypto cheat guide that will guide you this bull run. Unlock the secrets of crypto and make smarter investments today. Now by clicking on the link below to get your exclusive copy just under $10.
So an emerging market, when they have a recession or a crisis, it often doesn't look like a deflationary one. Instead, it often looks like a more stagflationary one because their liabilities are denominated in a currency they can't print. Their own currency often blows out in supply and therefore goes through a devaluation. So when you look at an emerging market in a recession, often in local currency terms, their financial assets are often doing pretty well. Their equity market could be doing all-time high in their local currency, and their housing market might be all-time high in the local currency. But when you price that in dollars or gold, it's generally not doing very well at all. And I think that's a thing we have to kind of apply to some of these developed markets, especially the US, which is to say, okay, so a lot of these assets are hitting highs in dollar terms. A lot of them have rolled over in denominated in gold terms, right? So we pick a harder currency that kind of ignores the fact that the denominator itself is being diluted. Then, the S&P 500 as a whole has actually had kind of been treading water with gold for a number of years now. And it's because that partly it's the denominator. So basically, when a country's in fiscal dominance, it's more likely to run hot than to run cold. And then therefore, even when it encounters kind of economic softness, the fact that the fiscal situation is still so kind of loose keeps things kind of higher than you'd think. So in cycles that are primarily like bank lending, when bank lending dries up, that can drive a pretty big economic contraction. But if bank lending is smaller than the amount of fiscal deficits just pouring into the economy quarter after quarter, then even soft patches can still be kind of hot. And then hot patches can be very hot, and they can come with a side of inflation as well. So they can, to many people in the economy, they won't feel as hot as they are because some of that is the denominator itself. And so, I mean, I just got back from Egypt, for example, and in Egypt they have double-digit inflation. Unemployment's not really the issue, but instead the issue is that everybody feels a little bit poorer in a recession there. Not because they lost their job, but because with their existing job, they can buy fewer things, especially anything that has an import component. So cars, computers, certain types of food, fuel, things like that. It takes more hours of labor to buy the same amount of stuff because that kind of the weakness gets diffused through the economy rather than isolated to just the people that lost their jobs.
What are some of the implications of the US's debt rolling over more at that short-term duration relative to longer term?
Well, that's another emerging market characteristic, although it's only directionally so. So in the extreme sense, sometimes when you have a fiscal crisis in an emerging market, they'll roll all their government debt over in short-term paper. And that's obviously a more extreme environment. A T-bill is effectively closer to a piece of currency than a bond. And therefore, when your whole government stock of debt rotates into short duration T-bills, It's kind of closer to money printing in a way. Now, the US is only doing that around the margins and kind of has just a longer runway to kind of mess around with this kind of thing. But effectively, what that means is yes, if interest rates come down, then they have more flexibility in refinancing at those lower rates. But on the other side of the coin, if interest rates stay high or go higher, that existing stock of debt has to refinance at those higher rates. The more impactful issue there is how it affected liquidity. And this is where it gets kind of wonkish. But when the Fed did QE during the pandemic, they did excess QE. They did like more QE than they needed to. And they actually ran into like banks had a certain point where the big banks couldn't take more deposits. It would start to affect their supplemental leverage ratio and other things like that. And so there's actually like spillovers where money had to go elsewhere. It piled into a reverse repo facility. And the Fed opened that facility so that they wouldn't drive T-bill yields below their target rate so that they would be able to be as hawkish as they want to. And so then when the Fed transitioned to doing quantitative tightening, because they did excessive QE before, there was this kind of remaining $2 trillion in the reverse repo facility. And all of that, like investors in the reverse repos, like mostly things like money market funds, would happily also invest in T-bills, but not longer duration treasuries. And so when the treasury was running into liquidity problems in 2022, 2023, one of the things they did was say, okay, well, let's issue more of our public debt as T-bills because we can suck it out of this reverse repo facility. And effectively what's happened is that the treasury has offset some of the Fed quantitative tightening. So in 2022, we had pretty much true quantitative tightening. We also saw asset prices do very poorly for the most part. But in 2023 and 2024, although the Fed was still doing quantitative tightening, the treasury was at a similar rate, sucking money out of reverse repos and putting it back into the banking system due to issuing that extra T-bills. It's kind of the only way to get money out of that void. And that's almost drained now, but that's kind of been a policy mix over the past, call it 2 years, of still being able to finance the debt without hurting market liquidity, kind of trying to have their cake and eating it too, which works as long as they still have money in the reverse repo facility, which they largely don't anymore. I think you can get indirect yield curve control. Certainly, they could turn to yield curve control if there was an explicit need for it. So the Fed discussed doing it during the pandemic, like in their meeting minutes. That's subsided now for a while. You can get indirect yield curve control, which is to say that they just don't raise interest rates as much as you'd expect compared to inflation levels or compared to other rules of thumb. And you can get wider spreads between treasuries and the rest of the market. So right now, mortgage spreads over treasuries are somewhat elevated. And if you look at the Fed's kind of long-term plan, they expect to eventually go back to buying treasuries, but continuing to divest over time through letting them mature off their balance sheet mortgage-backed securities, which effectively means that they're supporting the treasury market and no longer supporting the housing market, which makes sense under a fiscal dominance framework.
It's just another cycle? You might be wrong. The last time we saw conditions like this, skyrocketing government debt, aggressive Federal Reserve interventions, and a liquidity crunch, Bitcoin defied all odds and went on an unstoppable run. Now, the Fed is cornered. Either they print trillions more to bail out the system, pushing Bitcoin to new highs, or they let the system implode, driving people to Bitcoin as digital gold. Michael Saylor, chairman of MicroStrategy and one of Bitcoin's strongest advocates, reinforced this outlook in a widely shared podcast. He stated, Bitcoin is an economic scar. It's the only commodity in human history that's absolutely capped, which means you can expect it to keep going up. His company has relentlessly accumulated Bitcoin, even during downturns, showing unwavering confidence in its long-term potential. But here's where things get crazy. The 1985 Plaza Accord provides a playbook for what could happen next. Back then, the world's top economies had to step in and weaken the dollar. The US was forced to devalue, and what followed? Hard assets, gold, real estate, and commodities exploded in value. Bitcoin wasn't around back then, but today, it's poised to be the biggest beneficiary of any currency devaluation. And guess what? The Fed is already warming up the money printers. Now, let's dive back into the interview and hear more insights from LYN ALDEN.
Well, when any entity gets too leveraged, unless they can have some major productivity miracle, they're generally going to have some type of default. Now, if you're a household or a corporation that doesn't print your own currency, that default can be nominal. If you're a government that prints your own currency, instead that default tends to be through purchasing power or redefining what the unit is. So every time we change the dollar peg to gold or drop the gold peg altogether, that was effectively the default. We're changing, what the contractual unit is, making it less scarce. Or you can have a period where if you run interest rates below the inflation rate or below the money supply growth rate for quite a while, then if you're holding sovereign bonds, you're underperforming pretty much every other financial asset. So over the past, call it 5 years, if you held bonds, you lost out compared to equities, you lost out compared to housing, you lost out compared to gold, you lost out compared to Bitcoin. Any sort of scarcer thing outperformed. And then even in nominal terms, it was one of the worst periods in bond market history. And so while I don't think we'll repeat that scale of underperformance, when you go from 0 rates to 5 rates, that kind of crazy inflection point kicks in. But I think ultimately we're stuck in an environment where treasury bonds kind of are a lackluster asset to hold because kind of like background money supply growth, inflation eats away at any sort of potential yield you get. Everything else kind of keeps running hot to varying degrees. And the reason I refer to nothing stops this train is because I think the deficits are more intractable than most of the optimists think, which is to say that there's very narrow roads to actually meaningfully narrow those deficits. On the other hand, I don't think it's going to blow up, next year or the year after or the year after that. I think the runway that they have with, little moments of drama here and there is pretty long. And so I think the effective outcome is things run hot for a period of time, which has various investment implications for assets across the board. Well, so the first step along the way is the fact that there's high levels of political polarization that makes raising most types of taxes hard. Maybe tariffs are a different category, but it'd be very hard in the current political environment to raise taxes on Americans directly, like higher income taxes or higher corporate tax. If anything, they might go in the other direction. And two, even if you were to manage that, because the US is more financialized than most other countries, our tax receipts are heavily correlated to asset prices with a lag. So if you pick another economy like Canada or Germany and places like that, their tax receipts are more heavily tied to the state of their economy than what their stock market is doing. But because the US stock market is so big and so monetized, and the way that our tax structure works, and because of the amount of wealth concentration we have and how much of our consumer spending is driven by that upper third of spenders that generally have exposure to the stock market, we have this kind of feedback loop where if you try austerity to a certain kind of meaningful extent, it's likely to negatively impact asset prices. And then that's likely to manifest in lower tax receipts and therefore narrower deficit reduction than estimated to be. And so that Gordian knot is pretty hard to untie without more structural reforms, not just saying, hey, this tax rate's going to go from this to this. It's basically kind of overhauling much of the whole tax and spending system to begin with. While there are potential paths that could narrow it and therefore make the economy run less hot in debasement terms, I generally consider most of those to be low probability unless I see those begin to manifest. So I do think that we have higher kind of liquidity ahead, maybe a bumpy ride to get there. The biggest wild card where I don't know is tariffs, because if you jack up tariffs a lot and pull some of that global liquidity back in, then that's a liquidity offset. That kind of sucks liquidity out. So depending on how big tariffs get or how much uncertainty there is around them, that even if they don't get big, they kind of change corporate decisions for trade. That's probably the biggest overlay or the biggest question mark on top of what could otherwise be a decent liquidity situation. But that is also where earnings and valuation start to matter. So, in a given quarter or even a given year, things like earnings and valuation don't tend to matter too much. But of course, over a 5-year stretch, earnings matter. A company growing earnings at 15% a year is generally going to do better than a company with flat to negative earnings growth over that period, depending on starting valuations. So I think the biggest risk is in companies that have a lot of foreign exposure, because we have a lot of then unknown exposure to tariffs, geopolitical issues, that are trading at high valuations, don't have a ton of growth. And on the other hand, there are plenty of companies, I think, in the US and globally that are trading at pretty reasonable valuations, and they can probably take some punches along the way with liquidity. The other factor that is worth looking at is that, so in fiscal dominance, the deficits are more important than bank lending, but it's not to say that bank lending is not important at all. And if you look at senior loan officer surveys of banks, historically, whenever more than 40% of them are tightening lending standards, we're in a recession, going back 4 or 5 recessions. And in 2022, 2023, we hit that threshold without a NBER-defined recession. And the misery index, which is unemployment plus inflation, that reached levels normally seen with recessions. Consumer sentiment reached levels normally associated with a recession. But I would argue that it was overridden by fiscal dominance. So if you just looked at what was happening in the private sector, it looked like a recession. Now, we've come out of that to some extent. We don't have booming bank loans growth. We don't have like a booming lending environment, but we are off the lows that we were at a couple years ago.
With global debt soaring and nations struggling for liquidity, the options are limited: either devalue the US dollar, as seen in the 1985 Plaza Accord, or print trillions in fresh liquidity to prevent economic collapse. Either way, Bitcoin stands to gain massively. According to LYN ALDEN, the Federal Reserve could soon inject enormous liquidity into the system, flooding the economy with freshly printed dollars. Meanwhile, Bitcoin's supply remains fixed at 21 million, creating the ultimate supply squeeze. Each time the money printer runs, Bitcoin only grows stronger. History supports this. Bitcoin has consistently performed best in the spring and summer months, with March, April, and May delivering massive returns for the past 14 years. Even traditionally slower months like June and July have shown steady gains. Crypto analyst Plan B recently pointed out that every prior bull market, 2013, 2017, 2020, and 2021, had at least 4 months with plus 40% returns. With Bitcoin already nearing $96,000, historical trends suggest a new all-time high is on the horizon, and if the pattern holds, the coming months could see an explosive rally. The biggest Bitcoin supply shock in history is happening right now. Institutional adoption is at record highs, exchange reserves are plummeting, and long-term holders are refusing to sell. As liquidity floods the market while supply tightens, the outcome is inevitable: an aggressive price breakout. All signs point to a perfect storm that could propel Bitcoin into uncharted territory. The question is, will you position yourself ahead of the curve, or will you watch from the sidelines as Bitcoin rewrites financial history once again? For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.